Okay, let's do some questions from the weekly update. Some of my answers may be very simple, like I don't know, and when I don't know, I'll tell you. Like question one, half of it I don't know. What is your opinion on the economy of Great Britain, especially concerning the impending European oil crisis this winter? I don't know. I don't know where prices of assets are. I don't know how much is priced in. I'm unaware of the structure of the UK market or the European market for a lot of things, which is why I don't really include them in the market update because I really don't know. Now I could take the time to get to know it, but well, that's just it. Time. I don't have much of that. Next one. It seems as if they are dealing with some of the same issues as the U.S. High inflation, impending rate hikes, yeah. However, there's also the addition of this potential energy crisis. Plus, on top of all this, the new PM is for tax cuts and energy bill pauses, which could add to inflation even more. Well, I agree with you there. I think there's a time for tax cuts, and it's not now. But tax cuts, I'm in favor of tax cuts. Always in favor of tax cuts if it also comes with a reduction in government size. Or, let's say it a different way, if you are for small government, you must be for tax cuts, because what are you funding otherwise? And I think that the government's come to its citizens far too much to fund things. And you end up getting states like California, where even very liberal people who were more than willing to pay the tax rate for a very long time have decided, you know what, you guys are just making the wrong decisions at this point, I'm leaving. And there's an exodus out of money. The idea of the energy bills, subsidizing energy bills, this is the problem with politicians. I think that when they start messing around with with incentives, is they have a very linear view of incentives and they place the incentive at the wrong end. So this is saying, well, listen, we're going to help you out if your energy bills get too high. We'll subsidize it. That sounds like a nice thing, right? But where is the conservation in all of that? If I'm already going to hit the ceiling on what I'm going to pay, and then everything I use after that is paid for by someone else, where is my motivation to conserve anything? At that point, I'm playing with the house's money. What do I care? That a more interesting subsidization should be as a reward. That if you use year over year for the month of September, let's say, 30% less than you used last year on I get my bills every month. I can see exactly how much I use during the course of the month. It shows me the times I use it, the days. It breaks down everything. Utility companies track all your usage. If I come in at 30% less, then maybe I get a tax credit of 50% of that bill. There you go. There's an incentive. There's something I can work towards. Hey, I can get that, as opposed to saying, hey, listen, if I use a hell of a lot of it, I don't have to pay for it. Well, that's stupid, right? It is sort of like what the Democrat White House in the U.S., the Biden administration, was arguing about the capital gains tax. Their argument is why should people who work for a living pay more tax per dollar than somebody who doesn't but just earns a capital gain? Why a capital gain's not taxed at your income tax rate? Is because capital gains, the investment of capital, serves a purpose in the economy. Take away capital, you don't have an economy, so it serves a purpose. But rather than just having this linear thinking like, let's tax this if it moves, let's tax that, tie it to something. Tie the capital gains tax to the real interest rate. When the real interest rate is negative, means capital is plentiful, well then capital shouldn't be rewarded with a preferential capital gains tax. So that the capital gains tax is a sliding rate or a sliding function of the real interest rate. If the real interest rate is super high, capital is very scarce, maybe there's no tax on capital gains because that's specifically when the economy needs taxes. I mean, I find that politicians put the incentive at the wrong end of the stick. Much like the UK, hey, if you use too much energy, we'll pay for it. No, if you use less energy, we'll pay for it. Put the incentive at the right end of the stick, right? But politicians, they're not known for nonlinear thinking. It's very simple thinking. So Yeah, I think this would be stupid, and you can be for tax cuts, but there's a season for it. Keynes had it correct. You wait until you need to stimulate the economy to use tax cuts. When the economy is very strong and inflation is very high, Keynes also advocated that you should have higher taxes at that point to pay off all of the debt that you incurred in the last recession. So no, I am critical of most tax regimes because they are linear, but I'm not critical of using taxes the way central banks use interest rates. I think that taxes should be used to help monetary policy and be used as a function of the business cycle. I think it's also worth mentioning the fact that yields in UK are rising everywhere they are, while the pound is falling everywhere it is. There is one story in the world, and it is USD. Every currency is falling. The pound, the euro, the yen, the Aussie, the Kiwi, the Canadian. Oddly enough, not the peso. Year to date, it is held up very, very nicely. That I think that when the U.S. falls, starts dropping off of its high levels, which it has to, things just don't go in one direction forever. I'm getting kind of interested in that little fellow there. On top of this, what may happen to the English stock market if inflation continues to rise and the government gives these tax breaks, bill passes? That is called an unknown. Who knows how the market is going to respond on that one? I don't know. How did you cover your short position with short call of SPY at 390? It's just another short position, right? It is another short position with a lower DDB. So on August, on expiration, I didn't cover any of the calls. I had no problem with them being exercised. I had short calls. They were exercised, which leaves me with a short position on SPY. Not only that, it gives me lots of US dollars in my account because it is a short position. Average price 404, and on expiration date, the SPY I think finished that day at 422, so they were underwater. But I felt that we were in nothing but a bear market rally, so I didn't mind being assigned. There are issues with being assigned, though, when you have an actual short position in the ETF. There is a borrow fee. It's low, but there is a borrow fee. And depending on how long you're going to hold that short position, there are dividends quarterly. So there'd be a dividend outflow that you want to avoid as well. So when you hold a short position in the stock, you should know what the fee is for holding a short position. It's never free. It's never free to hold a short position. You're charged something. You're going to pay for something, and then watch this dividend outflow as well. So it got down to 392. I covered the short position 392 to 404, and this was a combination of short calls from 390. I think there was the 390, the 400, the 415s. They all got called, so it gave me an average of 404 on everything. Covered at 392 because I felt that 3,900 was probably the right place to be, and I thought that we would, drop to 39. I thought we'd bounce in around, let's say 39. Well, I'll call it 4,000, and maybe on the low end 3,850. I think is probably where we'll be for a while. So I didn't know that there was much more I would squeeze out of the 392. So I looked at the 390 calls at that time. They were paying 8 for September 16 expiration. So I covered and I just used the same number of contracts. So let's say you cover 1,000 shares, you sell 10 contracts, right? This raises the dollar delta beta because these have a delta equal to 1, whereas these calls here had a delta roughly about 0.5. I think it was about 5.6 to 0.6. It was so you're cutting your exposure in half. Now it is non-linear, so as it rises, you will rise back again to the full delta. But it gets rid of that borrowing fee. It avoids the dividend outflow. And if we are in this channel for a while, since there was $2 of intrinsic value, I basically pick up $6. So even if this continued to drop, or it stayed below 392, even if it stayed at 392, I wouldn't have made anything more on the short position, but on the calls, I'd make another $6 on time value. This continued to drop. We got into the 380, I think 388.50, 388.40. Because I had an alert set at 388.50, and at 388.50 I sold the 405 puts, roughly for about $19. I sold these puts to cover off some of the short calls that I had, but I wanted big overlapping dollars. So if you add these two up, it's $27 for a $15 spread. So I'm basically locking in $1,200 per contract if SPY stays between 390 and 405, or if the index stays between 3,900 and 4,050 by the 16th. Once it expires, if it expires at let's say 400, the 405s will be put to me and then called away from me at 390. So I'll be just left with $12 per contract, or well, $12 per share, $1,200 per contract. And my break evens are nice, 417 to 378, so 4170 and 3780. I had no intention of selling the 405 puts. It just got down to a certain price, and I thought, well, I could cover my calls, or I could, just sell puts. Well, puts have negative delta. I'm selling negative delta, so I add positive DDB. So this raised my DDB because it was negative. By trading off deltas of 1 for deltas of 0.56, and then by doing this I raised it again because selling a negative gives me a positive. So both of them are raising, which is what I wanted to do. As the market drops, raise my DDB. As the market rises, lower my DDB. And I just manage that on that position. Okay, on this one here, I'm going to show you the Mosaic Scanner in IBKR to find different apartment REITs, and it'll answer another question that was asked about apartment REITs as well. Let's answer this from the bottom up, actually. Yeah, we'll answer it from the bottom up, because once I'm done answering 3, we could just go right to the Mosaic Scanner. Number 5, can you explore or cover the Wu Xia shadow rate? For those of you who haven't heard of this, this was it's an older. This is an extension. These are the two authors, and it's an extension of the shadow rate concept. I think it was mid-90s. What are its implications, and how does it vary from the federal funds rate? It's just a model for deriving forward rates when the federal funds rate is sitting on the effective zero line. What do you do with that? So it's used when the FFR sits on the zero bound. If the FFR is greater than 0.25, the model is not needed, or at least their model is not needed, because it begins with the 1 month federal funds rate as the forward rate, which this is what it would do. The big thing here is it can assume negative rates even when the FFR doesn't have negative rates. If you want to know more about what they're using is an adjustment to rates that are already calculated using the Fed's model. You can go back to the market outlook for August 21st and the time frame between 1658 and 2552. I explain exactly what their model does. It's meant to map out the path of short rates so that you can not only explain the existing yield curve, but you can sort of project out where you think the yield curve might head to based on how you model it. And the Fed already provides, it's with a lag, already provides a whole bunch of data on this using, I showed you the 3 factors that they use. So you can go to this market outlook and go to this time frame to learn more, not specifically about this, but about just models in general. And there is a link in the description box to the data that these 2 authors then use to adjust for what they're doing. When you talk about long apartment REITs, our CPT and MAA wants to look at. Okay, that is actually part of this question up here. You mentioned apartment REITs are a good place to hide. I remember you talking about Avalon Bay, an agency in the U.S. markets a while ago. Are they not attractive to you at this moment? Yeah, I said AVB. If AVB goes lower, I would be looking at selling puts on AVB. Agency, mortgage REITs. You know what? When the Fed is done raising rates and signaling that, when they're near the end, then agency and mortgage REITs will probably have hit a bottom. And then I'll be interested in looking at mortgage REITs. Right now, if you're in mortgage REITs, it's fine. That has a good dividend stream, but I don't know that I'd be adding more to those positions. Only Canadian REITs? No, I'll show you how to find good American REITs. Also, agency is labeled as a mortgage REIT. That is correct, as well as a residential REIT. It is not. It holds residential mortgage-backed securities, but it wouldn't be a residential REIT. Not sure which is more correct. Have a good Labor Day. Let's look at, if you use interactive brokers, let's look at Mosaic Scanner. Okay, if you're in interactive brokers, click on Analytical Tools. And you will see the Mosaic Scanner. Click on that and this window will pop up. Up here, let's create a new custom scanner. Here's our universe. We're looking for stocks in the US. Here, it gives you all the exchanges, but get rid of pink sheet, no TCB over the counter, bulletin board, and we'll just stick with these. Filter by industry, and it says here all sectors. They haven't updated this in a while, so if we're looking for REITs, you actually have to go to the financial sector, because the financial sector was every sector of the economy or every industry group that is interest rate sensitive. That's why you have insurance companies, capital markets, banks in that. And mortgage REITs are still in the financial sector because it's interest rate sensitive, but REITs now have its own sector, which is real estate. But it used to be in the financial sector. So you still have to click on financial sector. All industries come down into REITs, and it says all categories. Let's go into apartment REITs, and we're done here. And you can select by other filters as well. So if we want to find, let's see, we're interested in you going into REITs because you like the dividend position. So let's take dividend. We'll take dividend yield. Also, let's look at analyst ratings and look at the average rating. Any other information we would like here? I think that's good enough, right? Why don't we put the price target, average price target in there as well, and we're done. And there we go. So there is a list of REITs that might be interesting to you. And you can sort this based on, if we sort on average rating. It just takes a while to resort. And from buy all the way down, so we can, if you want to go with whatever ratings, we can ignore this kind of stuff. You can see some high dividends here, 6, 6.3, and then you have 7.5 and 7. These are preferred shares. So if you want to grab some preferred shares, that's fine, but they're not going to have great performance in terms of price performance. Usually they hang out very close to $25. You see this at $24.47, $24.92, $25.30, $25.27. Look at the prices. They don't really move that much. So here are the other. There's Avalon Bay down here. So if we read across, this is a hold. So I said if it got down to 190, I'd be interested in selling puts. At 190, it would probably tend to be upgraded. Its average price target 233 from 210. So if you take 10% of the price, it's 21. That adds up to 231. Usually within 10% of the target price, you probably get a hold usually. So we can see some of the more interesting ones. Invitation Homes is up here. Let's see, American Homes for Rent, UDR. What's this one here? Next Point Residential. And it gives you the dividend yield. If you want to sort based on dividend yield, you can, but you have you can see the whole sector is basically buy or outperform unless the prices have held up very well. Then they're hold, because it's believed that, well, they've held up very well. These are probably very good ones that haven't retreated in price very much. Hence, they simply have a hold on them until rates stop rising and start heading down, because even though these are equity REITs, they are very bond-like, because they have, the rents can be seen as a stream of coupons. So they have probably more predictable cash flows than most other types of REITs. So they're treated kind of like a mix between equity and bonds, but their cash flows are very bond-like, so they will respond to interest rates the way bonds do, but not their empirical duration isn't as high as what a treasury would be. And there you go. You can do your own research and come up with your own list of REITs. Next question: what does soft landing mean? And you pretty much answer your own question here. Is the Fed expecting to have disinflation plus a strong economy? They're expecting to have disinflation with a slowdown. Not so much a strong economy, but certainly not a recession. So if we take a stylized business cycle with the expansion phase, there's the slowdown, there's the contraction. What they're hoping is that you'll get the slowdown because that will get rid of inflation, but that they can get this kind of thing going on and the expansion continuing on without it necessarily being a contraction. Is the Fed expecting 2.5% inflation, 4% unemployment rate, or somewhere in between? At the September meeting, we get the summary of economic projections, which we get every second meeting. And they'll update us on what they think their targets for inflation are, what their expectations for inflation are out to 2024, and economic growth, the real GDP growth, and what unemployment, their targets for unemployment. Next question: 50 million tax hit. This is for GM. When I talked about the $5 billion buyback, that if they waited until after January 1st, 2023, they would have a 1% tax on buybacks. 1% of $5 billion is 50 million. So there is motivation. Well, yeah, there is motivation to get the share buyback in, but not to the point of driving up the price, not to the point of missing the idea behind the share buyback is you're issuing, $5 billion. Companies will use that opportunistically, meaning that they'll support their price on weekdays as much as they can. They can't exceed 25% of the average daily volume, but they'll support their price. The hope is that they can buy back the maximum number of shares without, while still supporting their price. I don't know that they want to run the price up. That would sort of be a waste of the buyback, a waste of taxpayer dollars by pushing the price of the share up just to buy back shares, because you'll buy back fewer shares. Could you please review the tax thing on Wednesday? Well, that's just it. It's a 1% tax on buybacks after January 1st. They're already hostile about the capital gains tax as it is. Rather than changing the capital gains tax rate, they say, well, if we can't change that, since share buybacks are a way to return money to shareholders through a capital gain, let's tax the share buyback, which is in effect raising taxes on capital gains. Politicians, as I said earlier, are very linear in their thinking and very simplistic. They use, the taxes just sort of like a hammer. No finesse. They don't know how to tie it to incentives. So you could have a situation where if you're in a bear market, there's a lot of wealth associated with being that is lost across the board. And it's not just the top 10% or 20% that have exposure to equities. It's pretty much anybody who has on their paycheck any kind of source deduction for any state-sponsored pension plan. Everybody in Canada that works pays into CPP. CPP owns assets. So there's a time where buybacks make a lot of sense if they step in weak markets to support prices, because you're supporting asset prices for everybody at that point. Nothing wrong with that. Well, tie the tax to a situation that, listen, when times are good, when times are really great, return money to shareholders as cash. When times are not really great, when times are tough, maybe it might be better volatility-wise for the economy if companies supported their stock price. So maybe, when markets are return less than 0% in a year, if markets have a negative year, then you use that year to crowd in all your buybacks. Then you avoid the 1% tax. Tie it to something. This idea of if it moves, tax it. No, if it moves in a certain way, tax it, for God's sake. Anyways, that's all that is just a tax starting January 1st. Is it going to push a whole bunch of companies to buy back shares? Yeah, probably, especially on weaker days. You may as well. It's 1%. Companies are profit maximizing, and that tax is a pure expense. They're going to want to save 1% right there. So, yeah. I'm currently studying for CFA and CMT. That's a market technician. That's technical analysis. Only level 1 of both, but I've been trading using demo and cash for about 2 years now and becoming profitable. But I hear you're saying you missed this or sold too early. Well, that has been my my curse. I am pretty good at determining a direction. This will go up, this will go down. I'm pretty good at that, but I suck on timing. And I've heard it before. You should use technical analysis to time things. Yeah, or I could flip a coin, right? That's the benchmark for a technical analyst, is a coin flip. And I'll explain that in a second. My thoughts covering technical analysis to control your risk. What are your thoughts on intermarket analysis? There I differ. Intermarket analysis I find useful. And we do, in the weekly updates, we do some of that. When we look at where the yield curve is, where we look at the shape of the yield curve, where we look at different indicators of where we are. We've looked at leading indicators before. They matter. So we do some intermarket analysis, but not the pure kind. The pure kind is based on, look, I don't care what two markets these are. I'm looking at the correlation between them, and the correlation has, if you're plotting two things out and you're plotting correlation over time, you may notice that it's doing something like this, and then you see it do this. Well, what's going on? What's going on? Is it going to come back? The correlation's going to come back, but something's going on here, and this is basically a form of technical analysis where you're looking at why those two things have diverged. Fundamental analysts will do that as well, but then they then ask why, and they go looking for why. Is this temporary? Or is this something that is expected to last for a while? So if you were a subscriber, a CFA subscriber on my site, there was an applied series that was free to access. One showed the trade between live hogs and live cattle, that there usually has a 50-cent spread between the two. And whenever they deviate by more than 2 standard deviations, either too small or too wide, it was a trade. Well, that is a form of intermarket analysis. This is actually part of top-down analysis. So in the applied series, I've got the options up now, and I'm working on these sectors. I'm putting 6 up now. There will be 11, but there are 5 sectors that I don't really have a lot of experience with, that I've hired an analyst, different charter holders, to write up those sectors, because they work in those sectors. Great. I don't, you guys do. I know nothing about healthcare. I'll tell you that right off the top. I don't invest in healthcare. I know nothing about healthcare. Let somebody else write it up. So there's 6 of those up. The next is top-down. And top-down, the belief is that, well, that's macroeconomics. That's one part of it. That's one part of it. A big part of top-down is intermarket analysis, where you do look at correlations between certain yields and certain assets, or two different types of assets. You use a lot of ratio charts. Ratio charts are, the price of one thing divided by the price of another. It's kind of like a relative strength index, but rather than having relative strength based on its own past price history, you're looking at the relationship between two variables. So I have no problem with intermarket analysis. I think it is a great tool to use to get to the question why. But to then see something and simply trade it without the why, that's where I and the technical analysts would differ. Is I want to know why first. What is the fundamental reason why it's doing that? And is it temporary, or is it a break? For example, the gold-silver ratio for a long time was 50. If you divide gold by the price of silver, you got 50, and it pretty much held that relationship for quite a long time, till about maybe 15, 16, 17 years ago, it broke down. And the belief was, well, it always had that relationship. It'll return to that relationship, and it never did. It still hasn't returned to that relationship. So how long do you hold that in that sense? Natural gas and oil had a relationship of 10, that if you divided the price of oil by the price of natural gas, you should get very close to 10. And that broke down for a very long period of time because of shale. You had way too much natural gas being produced. So price of oil was going up and up, and price of natural gas was going down and down. It was below $2 at one point. It's now closer to that ratio of 10, but how many years did that take? How long do you stay with a trade like that, right? So you want to know why, and then in knowing why, well, is this a permanent divergence or is this temporary? What is the catalyst for this temporary deviation to be fixed? And if you can identify a catalyst, and that it's just a matter of time before that catalyst shows up, then yeah, you have a trade. I think I've talked too long on that. Anyways, the next module that we start putting up, this is from mid-October, or I think it's November, December. I'll be working on this one. Intermarket analysis will be part of the top-down analysis. Okay, for stock options, who can decide cash settlement or physical settlement? No one can. It's physical settlement. If you leave your options all the way to expiration, you don't close them out, and you end the day, expiration day, still with your options on Saturday before noon, it's all physical delivery. Option buyer, option writer, neither one. If you want to avoid physical delivery, you have to close your options. You have to, if you're long options, you got to sell them. If you're short options, you got to buy the cover, and then that's called a cash settlement. In other words, you've closed it, so whatever cash you owe or whatever cash that you had, well, that's the end of it. But if you hold them right till expiration, you do have the underlying delivered to you. Can you comment on your thoughts in terms of how this tax could have long-lasting impacts of how companies return cash to shareholders? Well, nobody knows, right? The long-lasting impacts, these are the unintended consequences. The buyback tax really does not make any sense to me, nor does it make any sense to me either. It's just, again, politicians are pretty unimaginative when it comes to taxes. It's either tax on, tax off. It's never let's tie this tax to this index. That doesn't occur to them, right? There's already a tax on buybacks of shareholders who will sell have a capital gain to pay tax on. Yes, they do. If you had a small business with 10 shareholders and one guy wanted to cash out and you take some money out of the corporation, you wouldn't pay out a special dividend to every shareholder. No, you would not. You would buy some of his interest and all of the shareholders' interest in the business. Well, this is private, right? If you had a small business with 10 shareholders, it's a private company. It wouldn't apply to you. You would need to buy out some of his interest and all of the shareholders. Well, that's if if you have 10. I think your analogy is a little bit off here, but if you have 10 and one is leaving and you're going down to 9, is it the company that is buying back the 1% and retiring the 1%? That's a buyback. Or is it the 9 that are getting together and proportionately buying the 10th one out? In which case, that's not a buyback. That's just a transfer of shares. So, it depends on how you see it as a buyback. But I agree. Overall, I agree that share buybacks are just another way of returning money to shareholders in the form of a capital gain. Why it should be taxed? You can make an argument that, well, look, if you're going to return money to shareholders, why not just do it with dividends? This way here, the capitalist system is supporting the economy in which it operates by paying taxes to a government which then does a whole bunch of things that markets don't do very well, like armies, and public schools. Although you could argue that governments aren't doing a very good job with public schools. So that you can take that argument and say, well, okay, I can understand that bills have to be paid. They have to be paid. And the buyback is a way of saying, we're not going to return it to you as a dividend. The buyback is flexible, right? The dividend is not. Once I announce a buyback, let's say I announce a $5 billion buyback, I don't actually have to buy back anything. But if I announce a special dividend for $5 billion, as soon as I announce it, As soon as I say, here's a $5 billion dividend, and I give a date on which the stock goes ex-dividend, it's contractual as soon as I say that. Now I can cancel dividends at any time, but a dividend once declared is now contractual. So by returning cash to shareholders with dividends, you pretty much have to go through with it until you cancel your dividend, which is typically a negative for the stock. But a share buyback, you can announce a share buyback, your stock price will get a boost, and you never ever need use your share buyback. You never even need to use it. You're not obligated to. So it does have some use beyond just returning capital to shareholders. In the end, here's what I think. I don't think this tax is going to stop at 1%. Why would it stop at 1% when the dividend tax rate is higher and the capital gains rate is higher? Why would it stop at 1%? Now, if you tax it at a capital gains tax rate, you're actually taxing the capital gain twice. Once when the company buys back the shares, and again when I then sell the shares with the higher capital gains tax in there. But again, politicians would look at that and say, so what? So what? It's only the rich. First of all, let me tell you this. There is no such thing as rich people. Get that out of your head. There's no such thing as rich people and poor people. Not in a capitalist system. That doesn't exist. There are successful people and there are unsuccessful people. That's it. So when we say tax the rich, what we're really saying is tax the successful people. And think about that when you want to say it that way. Tax the successful people. How dare they? How dare they live the American dream? Tax them to death. That's what I hear when I hear Elizabeth Warren talk. Next question. I believe the construction employee data is to a degree misleading. Working quite closely with this industry, the upticking in employment still represents compensation for project deadlines offset by COVID. As a compounding of construction projects due for delivery across 2020, 2022, and those budgeted for delivery since. Good point. Good point, because construction spending was holding up, and we clearly know residential housing is turning down. We can sit on the conference calls of the home builders and they're telling us they're delivering fewer homes. They see traffic dropping off. So when we see that construction spending was holding up, it is one of those things. And in the video I did put a question mark there saying, well, there's a bit of a question mark. There's our answer. Hey, the power of crowds. Beautiful answer. The construction of the CCC OAS from Fred notes that on the last day of the month, bonds are adjusted for accrued interest. Can you explain how this might lead to the index overestimate the CCC spread at the end of the month and underestimate the beginning of the month? This is partly true. It says here that on the last day of the month, bonds are adjusted. And this is what it actually says. When the last calendar day of the month takes place on the weekend, weekend observations will occur as a result of month-ending accrued interest adjustments. So that you have weekend observations occurring because, well, you have interest that does accrue, so the price of the bond will change, but you'll have no market price changes reflecting that. That's all that is just, if the end of the month, the 31st is on a Saturday, well, they're not trading on a Saturday, but bonds accrue interest every single day, so something's going on that day. But the price isn't changing, right? Only the accrued interest component is changing. So it looks like an uptick in the price. That's all it is just because of weekends. So if the last day of the month is on a weekend, you will have that. But if it isn't, then it doesn't affect anything. As always, thank you. Is there a reason why not to put on a relative short on the stocks? This is the SX5. This is the Euro Stocks 50 index and long SPY trade. I'm actually surprised that year to date the EU index is down just a couple of percentage points. I can't verify that. I get 21% down from its peak of 4,400. Year to date is down 19.14%, whereas the SPY is down 16.73 from the high. The high was basically the beginning of the year, so year to date and the high is basically the same thing. This is down more than SPY, so I don't know what you mean by a couple of percentage points. The Euro Stocks 50 is 50 stocks across 11 countries in the Eurozone, in case you're wondering. Very, very large companies. when we think about the euro stocks, this is in euros now. The price is in euros. If you want to turn it into USD to compare it with SPY, you have to take the euro losses in there because the USD went straight up. So, if you bought it at 4,400 euro, which was the high point when the euro was, let's say, $1.21, and it's dropped to, I think it's 3,400 now, 3,300, 3,400. And the euro is 99 cents. So not only did you lose this, but you lost this as well. So in US dollars, it's down even more. I don't know about shorting something that is the result of two things. You have a pullback in the market itself, which I think is rightly deserved, and then you have the currency effect. If these things reverse, this thing is going to fly up super fast because you're going to get a rebound in the stock price along with a rebound in the currency. And you want to be short that leg. That leg could rip your face off very quickly if this thing turns around. So I don't know that I would do that. Because on this one, it's not just the two markets, it's the two currencies. And the US dollar is, it's just been going straight up and up and up and up and up. When it breaks, it's going to break significantly. Right now money is just rushing into the US only because, well, where are you going to be? The pound, the yen, the euro? These are the other three big currencies. Where are you going to be? Most other countries' currencies aren't big enough, so money doesn't even try to get into those currencies. So it heads right to the US. So I'm puzzled by the Canadian weakness, but the Canadian weakness, if I had to break it down between how much is a result of Canada's economic data and how much is a result of a strong US dollar, that'd probably be 90%, 95% is the US dollar on that one alone. So this is a trade I personally wouldn't do unless I hedged out those two currencies. But even hedging out those two currencies, I don't see where my advantage is. If there's more weakness in the Eurozone, being that, some 40% of S&P revenues are from outside the U.S., how there's not going to be downward revision to the earnings estimate, I don't know. So if it's going to get worse, the SPY is going to drop as well. I don't know that I need a relative play on that. And again, you're comparing 500 stocks with 50. Well, I'd want to be a little bit more careful about what exposure these 50 have globally, because they're going to be big, large companies versus what the S&P has. Where's the breakdown of all the revenues? It's not just as simple as doing a trade in that respect. The relative trade, the relative trade that was, I think, fairly obvious for a while was short the euro, long the US dollar. That was the relative trade for quite some time. I think it still is a relative trade for a while. We'll see what happens when the European Central Bank makes its announcement this week. Okay, next question. The next question is a good question, and my answer is I don't know. Which seems odd being Canadian, but I'll explain what I mean by that. Thanks for the great content. I'm assuming most of the viewers are from the U.S. international, and of course U.S. market is what matters. However, if you can at least share a few points about the Canadian market in your videos, that would be very helpful. For example, I'm puzzled by the Canadian yield curve. It's very inverted. It seems there's no move at the long end. The Canadian banks seem very resilient compared with their U.S. counterparts. I don't know what I would say that they're very resilient. They have been selling off. BNS, Bank of Nova Scotia, is now, I think, under $70. I think their dividend yield is pushing close to 6%. TD's holding up kind of nicely. I haven't looked at the other ones, but at 6%, you got to get interested because none of the Canadian banks have ever cut their dividend. In over 100 years, 150, 160 years, they've never cut their dividend, and they have a history of increasing their dividend. So 6% almost seems, BNS almost seems like a long-term bond. at that point. The benchmark bond yields are available at Bank of Canada's website. So if we're looking for inversion, there's the 2 to the 10, which is 42 basis points. Why don't I talk more about the Canadian market? Is because I don't know much about it, which again seems odd being that I live in Canada, but I can fish in this pond or I can fish in a Great Lake. Well, the US is by far the bigger market, has much more liquid. In Canada, it's, your index is heavily weighted to materials, energy, and financials. I mean, that's basically your market. Materials, energy, and financials. That's it. Materials in the US, I think, have a weighting of like 2.5% in the S&P, whereas it's something like 16 or 17% in Canada. It's huge. Well, if you're going to bet on an index that is financials, index, and energy, why not just bypass that index altogether and just bet materials and energy, and then be selective on your Canadian banks? I just, if somebody asked me, some data point about Canada, I'd probably say, I don't know. What's Canada's unemployment rate? I don't know. I mean, I would just be guessing. I don't know what it is. And again, that does seem odd, doesn't it? It's because it's not the pond I fish in. So even in my own country, if somebody said, what's a good Canadian stock? I don't know, one of the banks or one of the apartment REITs. As far as apartment REITs, I think we had 6, now we have 5. Or we had 7, now we have 6. We don't have that many. We don't have that many at all, and I think I'm in 3 of them, and that's it. There just isn't. No, I'm in 4 of them. I'm in 4, and there's only one I don't touch, which is Boardwalk. There's only one I don't touch, and I'm in 4 of the 5. That's how small our market is. It's not exciting. However, here's the thing. If you look at what I look at in the U.S., I start with the rates, I start with real rates. As far as any real return bond, it's not that exciting in Canada, right? Smaller markets, less interesting data points. But if you do the same thing, start with rates, because rates pretty much tell you what should be going on almost anywhere. Go over to the housing market, because the housing market is a big leading indicator, especially new home construction. It's a big leading indicator for the demand for materials, the demand for labor, and the amount of income that is generated. Because the more construction workers you hire, the more income is generated, the more spending it is. That's really usually that is the start of the next boom, is when you see new housing construction start to turn up in a sustainable way. 3-4 months in a row, you see new home construction building. That's a big bullish sign, especially for financials. You follow the same process in your own country. I don't have to do it for you. I don't have to look at every country and look at the yield curve, look at the rates and do it. Just look at what I look at, and then go to your own country and look at the same things. Yes, it requires work, but this is a job. Like any other job, it requires work. You don't want to outsource your thinking all the time, right? So about US CAD, only from a technical point of view, I speculate we may have another major push higher to 134, 135. It's possible. Bank of Canada raised rates 75 basis points today and signaled they are not done. So that might give some support to the Canadian dollar, but it's a small economy, and money coming into the Canadian economy can go into Canadian bonds, but it's a small bond market, so there's not a lot of attractiveness in the Canadian market right now. And it's not really considered a safe haven. You probably 134, 135 wouldn't surprise me if it did that. We peaked over 132 today, so wouldn't surprise me. Curious to ask, how can one manage currency exposure effectively when USD is not the currency? Well, if you're in Canada, who cares what the Canadian dollar is worth? If you're buying and selling just Canadian assets, I mean, who really cares? If you're buying US assets and you're worried that the US dollar is too strong, you can always hedge out using the futures so that you have zero currency exposure. But you're never going to get to zero currency exposure. Or you can do what I do when I want exposure to US stock and I don't want the big currency exposure, is I use options to create a synthetic position. Okay. Next one, I wonder why you do not give any focus to trade ETFs from other markets such as emerging markets and developed ex-US. Is it just because you like to focus and specialize in one particular market? Is it because you are not drawn at the global diversification argument? This is the MSCI All Country World Index. Look at the weight of the US, 61.48%, 61.5%. There are, when you consider the business cycle, there are phase, and this will be covered in the macro top down when we do intermarket analysis. There are different parts of the cycle where you want to be in small caps, where you want to be in large caps, where you want to be in different sectors. Most analysts will say you want to get into financials in this area here, and you kind of want to get out of financials up here, and you want to get into commodities here and get out of commodities there. But if you look at it on a relative basis, I always find it's better to get into financials around here, because I'm looking for outperformance, not just performance from a bottom. So out here you start to get outperformance because you're close to the peak of the last cycle, where this is where the real growth in loan growth happens, is to build out newer and newer capacity. And this is where home building really starts to outperform, that you get this kind of thing going on with outperformance. And, small caps down here, large caps up here, especially large cap, low beta is where you want to be here. IT tends to do well starting from here, starts to grow because companies will add IT before they add employees, so that tends to grow. And there are different markets. Sometimes some emerging markets will do better at different parts of the cycle, depending on where we are in the business cycle, where the US is in the business cycle. And I think going forward basis, the US more so. The last 10 years you had to say, hang on, what about China? You gotta think about China. I think that its big infrastructure build out and housing is done for a while, and it was a big part of its GDP. That's going to be a big drop in demand for materials. So the relationships that held from 2004, 2005 till about 2 years ago in China, I think those relationships are done for a while. So it's not that I avoid these ETFs. I think that there is some value in them. It's just, if you have a limited amount of time, you try to find the biggest markets, and the US is by far the biggest, most liquid market. When you start looking at some of these ETFs that will trade specific markets or specific sectors in ex-US, they get very illiquid very quickly. That some of them have, especially in the materials sector, you can find ETFs that track different sectors in materials, for example. Because take Peru, for example, I think their market is, almost like 70%, 75% materials based. But the ETFs you'll get are very illiquid with very illiquid options. Which means you're going into the markets themselves and buying exposure to those particular markets. But the ETFs get very illiquid. For a small retail investor, maybe, but for size, and I have a portfolio of a certain size, it doesn't really help me very much that I can get exposure to different markets in different ways depending on what their major export is. But it's not that I avoid it. It's time. Right? There's only so much time in the day, and think about it this way. I'm picking up golf balls in this particular creek, and there's a lot of golf balls. Now you can say, hey, there's a small lake over there and another creek with golf balls, and I could say, but look at all the golf balls here. I got lots of golf balls here already. Why would I leave these golf balls to go looking for golf balls in the other creek when I can see plenty here and it's getting dark out? I don't have that much time to be picking up golf balls. So that's the way it is. It's a question of time. We're almost done here. In the IBKR Risk Navigator, how do you normally go about using DDB to analyze a portfolio made up of positions traded in different markets? Well, that is a good question, right? Are you assuming that each market has a beta of 1? and looking at each position. In other words, saying here's a sub-portfolio, here's a sub-portfolio, and here's a sub-portfolio? Or are you assuming that the U.S. market has a beta of 1 and everything else will be a beta to that? And that's the way I would look at it. So if I had exposure to the U.S. market, it has a beta of 1. And if I have exposure to the Canadian market, which will have a higher beta than the U.S. market, because all the betas are relative, right? Relative to the U.S., it will have higher market sensitivity, only because it is in more cyclical sectors, or has a higher weighting in more cyclical sectors, in materials and in energy. So I would probably look at it in terms of one currency. That's the way I would do it. Now, you can do it however you want. It'll give it to you in terms of position itself. Now, if you were using, let's say you had Europe exposure, Asia exposure, and US exposure, and you were using the contracts within each market to lower your risk, then sure, you can look at each market independently and use the contracts in those particular markets to lower it. But it is very common, even globally, even for international investors, even for asset managers that have no U.S. exposure. Let's say an emerging markets asset manager that is holding, $200 million in emerging market equities. You don't hedge that out very easily at all. That manager will have some measure of some hedge ratio that is used in terms of the S&P 500. And rather than trying to hedge out the risk of each emerging market, we'll say, well, as a portfolio, what is my correlation of returns with the market? What beta does my portfolio currently have with the S&P 500? And I will use S&P 500 index options to hedge out any risk, which is why the S&P 500 tends to have that kind of skew all the time, because the demand for puts far exceeds the demand for calls. The index is used as an insurance company. I'm going to head over to the S&P and I will share everything. So since this is used in that respect, they would probably use the U.S. market having a beta of 1. I have a question about funds and ETFs. You can buy funds that are managed by institutions. Yep, you can. They do have higher fees. Is it a logical decision? Well, lots of research shows that managers do not outperform in the long term. That from year to year, if this is the market return, you will get a distribution in manager performance year to year. But the further out you go, the tighter and tighter this distribution gets, so that you have a distribution that looks like this. It gets tighter and tighter, so that those who underperform tend to overperform, then perform in line, and this kind of thing happens that over a long period of time, they tend to all perform in line with the market over longer periods of time. So what are you paying for, right? ETFs, I think, make a lot of sense because the management fees are low, especially at the sector. Once you start going down from the sector to the specific industries, the management fee does increase, as high as maybe 25 basis points, 30, 35 basis points in some cases. But I don't know that, given the performance of active managers, I don't know that it's worth paying that extra fee over time. Unless if you say, well, but I can pick winners every year. Well, if you can pick winners, then pick sectors that are winners and do it that way. However, the other side of that is, and I've heard this complaint quite a bit, is that way too much money is rushing into passive portfolios. And an ETF is a passive portfolio because it doesn't make any active decisions. It holds exactly what the index has. It has no active risk. It only has the index risk. And there's way too much money that is simply just tracking that and not making wise decisions. Because when you buy into the ETF, you're buying all the shares in the ETF in proportion to how they're held, regardless of what their fundamentals are. So who is left to actually trade the underlying to its fundamental value, right? kind of a paradox. Whose paradox was that? The Stiglitz paradox? I think if you Google Stiglitz paradox, that's his argument. So, my thinking is, no, I'm not going to pay for active management, especially if I'm buying ETFs that have large cap stocks in them, because it's brutally difficult to outperform a large cap index. Because they are probably the most efficient in terms of pricing, because they have the largest analyst following. Let's see, next one. As always, thank you for the updates. While on the subject of taxes, how do you think the new 15% corporate minimum tax in 23 will affect markets? Only applies to companies with over $1 billion in annual earnings. Do greatly affect large institutional investors that have buy and hold? I don't know so much that it's a big deal. Overall, I think that it ends up affecting like very few companies. The idea behind it is that you have net income, taxable income of $1 billion. And that is your taxable income. However, because of the nature of your business, you have a lot of tax deductions, legitimate, congressionally approved tax deductions. You might have a tax loss carry forward. You might have a huge depreciation tax shield. You might have a capital structure that allows you, you have the tax shield associated with interest. So that once you use all of your tax shields, which are legal, which Congress already said by passing these laws in the past, saying these are laws. They're not loopholes, they're laws. I can guarantee you large companies and their auditors, for the most part, other than outright fraud, large companies for the most part are saying, hey, listen, don't mess around with this shit. And same with auditors, are saying, look, this is the way it is, that you could have these earnings, and with these tax shields, you could get to a point where the company doesn't pay any tax because they have a tax loss carry forward. That's a good example to use. They have a $3 billion tax loss carry forward. They have $1 billion in earnings. Well, they don't pay any tax that year, and they pay no tax on the next $2 billion. All they're saying is, okay, look, if you get to that situation, you hit the minimum 15%. Well, it's not like they lose anything. So if they had a $3 billion tax loss carry forward, instead of having a $2 billion tax loss carry forward, they have a $2.15 billion tax carry forward. They still have it. It just takes longer to use, but it will have a cash flow effect in that they do have that minimum tax to pay now. Let's say that they used all of their tax shields and they got down to a 16% tax rate. Well, there you go. 16%, that's what they'll pay. It's above the minimum of 15%. That minimum is just to ensure that companies that are profitable in a given year pay some tax, even if the last 3 years they were completely unprofitable. So you could make the argument by saying, but hang on a second, we want companies that are large, that can create huge amounts of employment, that are going to be cash flow negative for a while. We want them to stick with it. So they're going to have a whole bunch of built up losses. So that means once they do start earning some money, hey, they paid their dues. They paid their dues by losing money. Shareholders ponied up money. We lost money. The debt holders put in money. And it was a big amount of risk to have taken, but it's created all of these jobs that now that they're making money, they've paid their dues. They should have that tax shield for a while. That's a law you guys put in. Now you're changing the rules of the game to say, oh, well, we don't like it now. We liked it when you were losing money, but still created employment, still invested in the community. We like that, but now that it's working out for you, oh, we don't like that. Yeah, there's that argument that you can make as well. That if you don't like the idea that profitable companies don't pay any tax, well, it's your laws that allowed them to do that. Change those laws. But every time, in a complex system, every time you poke on something, something else moves somewhere else. So is this going to have an unintended consequence somewhere? Yeah. Where? Who knows? That's why it's called unintended, because you just don't know exactly what's going to happen. But it's going to cause something. I just don't know what. I don't think anybody knows what. But that's all it really was, is to say, look, at least we get it. you're following the rules, you owe nothing, but at least pay the 15%. But then they walk around wagging their finger like, we're going to make profitable companies pay their fair share. First of all, they were. It's a lie. They were. You're just doing it not and it is a stupid thing to say because it's not true. That's not exactly what you're doing. It's a stupid thing to say, but politicians, understand this. Politicians don't say stupid things because they're stupid. They say stupid things because they think you're stupid. Think about that. Next one. As always, thank you for the market updates. Well, on the subject of taxes, how do you think the new 15% corporate... Oh, already answered that. Okay, we're done with this. With the 75 basis point rate hike expected, happened. Let's put the word happen. I know you wrote this before this, but it is a fact now. How do you think this will impact the Canadian real estate market in the short to medium term? Secondly, well, that's two things, the short and the medium. Big question. Canadian home prices. Detached GTA homes in particular, yeah, have dropped 15 to 20% since their peak. 15 to 20% from an unrealistic peak, by the way, in February. What do you think is causing the disconnect compared to the U.S. real estate market, which has held up better this year? Well, the Toronto market got way too overheated, number one. Way too overheated. So you could do the same thing in the U.S. You're basically saying, how come this city doesn't match this whole market? But you can go into the U.S. and take certain cities that have fallen a lot and some that have not fallen at all. So you have to look at the Canadian market versus the U.S. market. But if you're looking at particular metro area, you'd have to try to compare it with a comparable metro area in the U.S. A big difference between the metro areas in the U.S. and the metro area in Canada is there are more of them in the U.S. There's more choice. There's not a lot of choice in Canada. When airplanes land, because we have immigration, when they land, they tend to land in one of two cities, Vancouver or Toronto. Based on the level of immigration we have, you have roughly 1,000 to 1,500 immigrants landing at Pearson International Airport every week. Well, they got to live somewhere. Every week. Next week, another 1,000 to 1,500. Well, they got to go somewhere. Every single week. The difficulty with home prices in much of Toronto, and you have this in places like North York, Mississauga, Brampton, is you're not competing with another bidder. You're competing with a family of bidders that have 5 or 6 income streams in that household. You're never going to outbid them. So if you're a westernized family, a typical Canadian westernized family, husband, wife, couple of kids, that's hard to compete against an Eastern family, which typically is multi-generational and larger. So it is not uncommon to have 3 generations in the house. It is part of the value system that they have. They just live differently. They cohabitate differently than Western families do. And a lot of the cities were never designed for that kind of density. But you're not going to compete against somebody going up against a house that has 4 or 5 income streams in that household. When you have 1, maybe 2 income streams, you'll be outbid almost all the time. So it's, that's immigration really in Toronto is what was driving the price considerably. The second thing that drives the price in a lot of these metro areas is they end up being huge tourist attractions. Nobody visits Thunder Bay or Barrie. Nobody says, I know where I want to go on my vacation. I'm going to travel up to Canada and go to Barrie or Ingersoll. No one's going there. You're going to Toronto. So the Airbnb, especially the professional Airbnbers, they're owning 5, 10, 15 condos. And some of the houses. I think something like 20% or 1 in 4 houses are bought for investment, not for living in. So you have that big thing happening as well, which you're competing with somebody who's going to turn over that house every 3-4 days for significant dollars. The housing market, what's going to happen with the rate hike is, and I'm already seeing it here, is houses are taken off the market. Because once they fall, 15 or 20% below the peak, you got to buy a seller who says, well, if I sold it in February, I could have got $1 million. Now I'm gonna get 775 or 800,000. Forget it. I'll just wait, even though they paid 6, because in their mind they're losing 200,000, not making 200,000. If they sell it for 800,000, they're losing 200, and they're not going to do it. So you see houses being taken off the market. If they can, if there's no need to sell, they just take the house off the market. So housing prices on the way down, kind of sticky, like wages. They'll fall to a certain point, and that's really about it. So I think that the prime buying season for housing is probably going to be November, December. You had the 75 basis point move now with more expected. I think that's going to hit. Wait 30 to 45 days. That'll ripple through the housing market. Some people will take their houses off the market. Others with variable rate mortgages might have to put their houses on the market. And then, I think that's probably the time to buy. But we have a housing shortage still. So don't expect all of this, this huge amount of supply, and it's a buyer's market. It'll just be more balanced. And I think that's about the best that you can hope for. Let's see, what do we have? I didn't fully understand when you mentioned Fed controls risk and credit metrics and National Financial Conditions Index, while the market only controls the leverage index. Didn't quite say it that way. I said about influence, that the Fed has a lot of influence on risk and credit because they set the price of risk. They set the price of credit. So they can raise the interest rate, and the interest rate will affect the price of credit and the availability of credit, but it doesn't naturally affect stock prices. The idea is a higher discount rate should affect stock prices, but you have a market that then decides to set the price wherever they want to set the price, so that the market, individuals have more influence over the leverage component, whereas the interest rate has more influence over the risk and credit components. It says here, risk credit spreads, ABS spreads, VIX, and credit equals loan availability. Well, loan availability standards get squeezed whenever the price of a risk goes up, right? Mortgage spreads, credit spreads, these are all related to the interest rate. Largely controlled by the bond or credit market participants, not the Fed. Well, it's not controlled by the Fed. It's heavily influenced by the interest rate, and the interest rate can affect this and this most directly. And then prices after that are a derivative of where interest rates are. So it sets kind of like the floor price for what risk-free is, and then all credit is priced above that. So hopefully that takes care of that. This morning we got services PMI from both S&P Global and ISM. S&P Global version showed contraction in the services sector, printed at 44.6, while leading indicators such as new orders declining. ISM showed growing services sector 60.9 with strong new orders. It's a difference in their sample and how they count things. ISM counts more industries than S&P does. ISM polls its own members, which tend to be larger companies. S&P has a larger data set, I think 400 versus 300. And it'll have some smaller companies in there as well, which, if we're looking for trends, are you looking at the bigger companies? Bigger companies really set the trends. Or are you looking at the smaller ones? I don't know that the smaller ones set the trends. So, there are pluses and minuses. However, there is a link in the description box which goes through all of the differences between the S&P Global and the ISM. And then you can decide for yourself which one you think is more relevant. And that ends the questions here. One last statement I'll make for the applied series, in case you were, keeping your eye on that. It is expanding over time. So access is for quite a long period of time, and access is for sections that aren't even built yet, that will be built over time. However, starting September 15th, the price increases, because as I keep adding more and more sectors, the price itself will increase, and then each component will be available on its own as well. So starting September 15th, The options course will be available on its own, along with the sectors course will be available on its own. But the series bundle price is going up. Right now it's $220. Once I'm done with everything, it's well over $1,000 for all of the different sectors that are being developed. So if you get it in at $220, you have all of the sectors that are added if you buy the bundle. But as each sector gets filled out, or as each section of the applied series gets filled out, the price does incrementally increase. September 15th is when it jumps. I think it goes from 220 to 320. So, you know, just fair warning on that one. If it's something that you were interested in, or something that you were looking at saying, you know, I'll pick that up later, just be aware that, what is it today? Today's the 7th, that's the 15th, 8 more days and pricing changes. See you Sunday.